Hi, in this video, we will see the two methods of treatment of reserves, accumulated profits and losses, and fictitious assets. Now, before we go into that, first let's see why is such a treatment necessary. So why do we need to treat reserves, accumulated profits and losses, and fictitious assets at the time of change in profit sharing ratio? Now the reason is that all reserves and accumulated profits and losses and fictitious assets were created when the partners were sharing profits in an earlier ratio. If as a result of the change in profit sharing ratio, any specific partner gains or sacrifices, then such partner should not be put to any undue advantage or disadvantage. So the reserves, accumulated profits and losses, etc. were created at the time the partners were sharing profits in the earlier ratio or the old ratio. And definitely, as a result of change in profit sharing ratio, any partner may gain and another partner may sacrifice. So this gaining partner or sacrificing partner should not be put to any undue advantage or disadvantage. That is why before the change takes effect, we need to treat reserves, accumulated profits and losses. We'll see what the two methods are for treatment of reserves, accumulated profits and losses, and fictitious assets. Now, method 1 is used when reserves, accumulated profits and losses, and fictitious assets should not appear in the reconstituted balance sheet. And what is a reconstituted balance sheet? The balance sheet which is prepared after taking into effect the change in the profit sharing ratio. And method 2 is used when reserves, accumulated profits and losses, and fictitious assets should continue to appear in the reconstituted balance sheet. Let's go into detail about when to follow method 1 and when to follow method 2. Now, when do we follow method 1? We know that method 1 is to be followed when either nothing will be mentioned or the question says reserves and accumulated profits are to be distributed and fictitious assets and accumulated losses are to be written off, or the question may say that reserves, accumulated profits and losses and fictitious assets should not appear in the reconstituted balance sheet. So in either of these three cases, we know that we need to follow method 1. Remember, if nothing is mentioned, we need to follow method 1. So when do we follow method 2? We know that method 2 is to be followed when the question says reserves, accumulated profits and losses, and fictitious assets are to be adjusted through the partner's capital or current accounts. Or the question may say that the reserves, accumulated profits and losses, and fictitious assets should continue to appear in the reconstituted balance sheet. So in either of these two cases, we know that we have to follow the second method. So now that we know when to follow method 1 and when to follow method 2, we'll go into detail about the treatment in method 1 and method 2. We'll begin with method 1. In method 1, all reserves and accumulated profits that appear in the liability side of the balance sheet is to be distributed amongst the old partners in old ratio. So as per the change in profit sharing ratio, the existing partners in their old profit sharing ratio. So the reserves which come on the liability side of the balance sheet, and when I say accumulated profits, it means P&L balance appearing in the liability side of the balance sheet. Now these two will be distributed among the old partners in old ratio, and for these liability side items, the journal entry is as follows. Again, for distributing reserves and P&L balance appearing in the liability side of the balance sheet. Now we need to debit the amount of general reserve and also the P&L balance appearing in the liability side of the balance sheet and distribute it among the partners' capital account where the fluctuating capital method is being followed, or the partners' current account in the case of fixed capital method. So this will be distributed in old profit sharing ratio. So we debit the general reserve or reserve with the amount of reserve appearing on the liability side. The P&L account we'll debit with the P&L balance appearing in the liability side of the balance sheet, and credit each of the existing partners with this amount which is divided in the OPSR or old profit sharing ratio. So we discussed the items that appear in the liability side of the balance sheet. Now what about the asset side items? Accumulated losses, which is the P&L balance appearing in the asset side of the balance sheet, and fictitious assets, it could be deferred revenue expenditure or its example advertisement suspense, that appear in the asset side of the balance sheet has to be written off amongst the partners, that is the existing partners, in their old profit sharing ratio. And the journal entry for the same will be, in this case, we will debit the partner's capital account for fluctuating capital method or partner's current account in the case of fixed capital method, and we will credit the P&L account balance amount appearing the asset side of the balance sheet representing the accumulated loss, and credit the deferred revenue expenditure, advertisement suspense, etc. So after crediting these items appearing on the asset side of the balance sheet, we will distribute it or write it off among the existing partners in their old profit sharing ratio by debiting them. Now a small tip for us to remember the journal entries. If we recall, we said method 1 was to be used when the reserves and accumulated profits and losses and fictitious assets should not appear in the reconstituted balance sheet. Now the reserves and the P&L balance appearing in the liability side of the balance sheet, it has a credit balance, and we will debit these two items and distribute it among the partners in their old profit sharing ratio, thus cancelling these two accounts. That is why the journal entry is passed as reserve account debit, P&L account debit to partners' capital or current accounts in old profit sharing ratio. On the other hand, the accumulated loss, which is the P&L balance appearing in the asset side of the balance sheet, and advertisement suspense both have a debit balance. So we will debit the partner's capital and current account and credit these two items and thus cancel the amount of P&L or accumulated loss and the advertisement suspense. Next, let's go into detail about method 2. In method 2, we need to ascertain the net effect of all these items. And to get the net effect, this is what we will do. We will apply the formulae, the free reserves plus the P&L balance appearing in the liability side of the balance sheet minus any accumulated loss, that's a P&L balance appearing in the asset side of the balance sheet, minus any deferred revenue, expenditure, advertisement suspense. So after doing this, we will find out whether we get a positive figure or a negative figure. The journal entry will depend on whether the net effect is positive or negative. Again, remember, the liability side items will be added up and the asset side items like advertisement suspense and accumulated losses will be deducted from the liability side items, and then we will ascertain whether we are getting a positive figure or a negative figure. Now, in case the net effect is positive, the journal entry to be passed is to debit the gaining partner's capital or current account and to credit the sacrificing partner's capital or current account. And the amount will be the amount which we have to debit the gaining partner for and credit the sacrificing partner for will be the amount of the net effect multiplied by the share of gain or sacrifice. Share of gain in the case of a gaining partner and share of sacrifice in the case of the sacrificing partner. Narration being adjustment for reserves and P&L and advertisement suspense made through partners' capital or current accounts. Now, as we earlier saw, the partners' capital accounts is used in case of fluctuating capital method and partners' current account is used in the case of fixed capital method. Now, what happens if the net effect is a negative figure? We just need to reverse the journal entry which we passed earlier. In this case, we will debit the sacrificing partner's capital or current account and credit the gaining partner's capital or current account, and the amount for debiting or crediting these partners will be the amount of the net effect into the share of the sacrifice in the case of a sacrificing partner and multiplied by the share of gain in the case of the gaining partner. And as always, the partner's capital account is used for fluctuating capital method and partner's current account is used in case of fixed capital method. So we've seen the two methods of treatment of reserves, accumulated profits and losses, and fictitious assets. We also learnt when we have to apply method 1 and when we have to apply method 2. In the upcoming video, we will solve a few sums under this concept.